Hello and welcome to another episode of the Monday Macro View. And in the recent week, there were a lot of projections and outlooks released, and I'm going to, because of the shortage of time, I'm going to discuss two of them. First one is the IMF's economic outlook, and the second one is the World Oil Outlook 2045 by the OPEC. So going to start with the first one, the IMF's one, and the reason why am I doing this is because it is helpful given the fact that we've recently covered a lot of the economic data coming out from China, US and other major economies of the world. This kind of puts things into perspective. So recently the baseline forecast for global growth has been reduced from 3.5% in 2022 to 3% in 2023 and 2.9% in 2024. This means that there still would be headwinds for the global economic recovery as we move into the new year. This also fits neatly with the global financial stability report, which also called for headwinds and challenges and hindrances in the terms of the momentum that is required to pull off that global economic recovery and reach the pre-pandemic levels. Amongst the advanced economies are expected to slow from 2.6% in 2023 to 1.5% in 2024, and similarly, the effect on the emerging and developing countries is even more worse. Moving forward to the output levels and sort of determining which sector have really made it so far in terms of its stability, things aren't looking very good. First of all, you compare you can see on this chart, this is the real GDP loss, this is the real domestic demand shortfall, and all of them points towards downward trends, especially if you see on the right-hand side of the EMDs, the emerging markets and developing economies, and low income and developing countries. So emerging markets and developing economies have seen weaker recoveries as compared to advanced economies, and the average output there would be 6.5% lower than expected. This in amounts of rupees, in amounts of dollars, this would amount to $3.6 trillion less than the pre-pandemic levels. You look at the next chart, and this shows really what we are talking about on ad nauseum basis. Mark in his Econ Show, in this Monday Macro View, we've been tracking data coming out from Eurozone, coming out from China, coming out from US and other major economies of the world, India, Turkey, and then developing countries. And once again, IMF's forecast cements the fact that there has been a slowdown, a global slowdown, persistent slowdown across the board. You can see this chart here, which shows industrial production and trade, which is expected to weaken further. You can see the cumulative excessive savings are also heading downwards. This also relates to the point of an expected recession in the US, because so far the consumer markets have been strong and the consumer spending in the US have been coming strong. But this has been building on the back of the pre-pandemic savings. But now, as this chart on the right hand side shows, these are now declining. So moving forward now, this was released, World Oil Outlook 2040. This was released by OPEC. I was, as I told you in the last show, I was here for an Energy Markets Forum in Fujairah, had the honor to speak on it, and also attend OPEC Secretary's speech, which was quite realistic, and I really liked the points he made. Some of the points we have already been talking about a realistic and just energy transitions, and the OPEC's oil outlook sits quite on the opposite side of what the IEA considers. So IEA thinks that oil demand would peak by 2030 or 2035, which is only 6 years from now. So that does not look realistic. On the other hand, we have seen that oil demand, if it hasn't registered a growth, but it has stayed the same despite Russian-Ukrainian sanctions and the tensions. This outlook by OPEC sorts of feels more realistic, because according to this outlook, by 2045, the oil demand would reach 116 million barrels per day. That's 16 million barrels more than the current levels. Also, why would this happen? There are different factors. First of all is that, look at the next chart, the world population trends. So the population, as we all know, especially in Africa, especially in Asia, the Eurasian region, as it has come to be known, the trends there are showing upward direction. So as population increase, people would strive more to increase their living standards as well. Another factor which was very important in this chart was um, the trends in the global economy. So right now the global economy is around 105 trillion dollars. It is expected to double to 200 something trillion dollars by 2045. So both of these factors, amongst many other factors, would majorly be causing this increase in demand for oil, and this seems realistic. On the other hand, I also recognize and realize that this would cause a lot of ecological concerns. But once again, this isn't the topic for the show today. But the ecological concerns need to be seen or viewed within the framework of just transitions. And when you look at that, so it turns out many countries in the world, majority of the countries of the world that would be having the most economic growth, population growth, they would not be able to pull off this sudden shift to cleaner technologies. They would need more time. Finally, if you look at the market sentiment tracker chart, which I was not able to make last week, this week it shows some sort of new additions in the recovery side, the bullish side. So Germany's industrial manufacturing rose a little bit. U.S. economy is expected to grow 5% in the third quarter. Retail sales in the UK have increased. Eurozone's industrial output also edged higher, which is somewhat good news. Still not there, but it was better than what it was in the previous month. India's service sector will also register growth. On the other hand, the left-hand side, the recessionary side, the bearish side, you still see inflation in South Korea is rising. China's PMI is still below 50. US credit card debt has hit a new high, $1.03 trillion, and the delinquency rate has also hit high. So we were talking about the excess savings in the previous slides. You combine the fall in the savings, you combine this with rising debt levels, you combine this with persistently high monetary policy tightening cycle, and you get a good recipe for an imminent or impending recession in the next year. Most of the indicators that we have been talking about, they are leading indicators. So the result of that, the impact of them would appear in the near future. According to many analysts, it appears that the winters or next year, by early next year, we would see the impact of this rising monetary policy tightening in the labor markets, and also the falling PMIs, the falling indices, manufacturing indices. They would show its impact as we move forward. You see, job openings have jumped. The US debt is rising. Leading economic index was again down in last month, and the recent geopolitical flashpoint, the unfortunate events in the Middle East, can go either way. So that's all from this side today. I'll see you all next week. Thank you so much for watching.